Thank you, Fred, for the introduction. So we had been told 15 minutes, so I'll try to be even more succinct. So this project and the ones in this session are going to be concerned about taxation, and I think we're all facing the same challenges in low-income countries, which is that of low revenue collection. Roughly, the stylized fact is that developing countries collect 15 to 20% of the GDP in taxes versus OECD countries at 35 or 40%. And so the main explanation in the literature has been that of weak fiscal capacity that enables tax evasion. And two dimensions of fiscal capacity, and maybe two of the central dimensions of fiscal capacity, are weak audit processes. And there's many things going into there that we're going to unpack a little bit, and limited third-party information. And that is hard to cross-check information across different sources. And so some common features of tax administrations in sub-Saharan Africa are a large discretion in audit case selections that allows inspectors to use soft private information and experience to select cases for audits at the cost potentially of bias, misjudgment, or rent seeking. A second feature linked to the third-party information is that even though typically different databases exist, for example, the customs, the corporate income tax, the value-added tax, it's very hard to link those sources. Sometimes because there's no unique identifier, sometimes because even though there is a unique identifier, for example, the customs won't give the data, or it's pretty hard to do those measures. So this study, we're gonna study all firms that are part of the large and medium taxpayer offices in Senegal. These are around 4,000 firms. And we're gonna be concerned with two types of audits: comprehensive, which are maybe the ones you have in mind, where you go to the firm and you sit with it for a few months, you go over all the books and so on, and desk audits, which are you do typically by just cross-checking information, and then you can call the taxpayer for some further information if there's something that looks fishy. The research question and the hypotheses are: how does discretionary case selection, which is the current way that it's happening in Senegal, compares to a risk-based system for selecting cases to audits and to pure random selection? And secondly, what are the returns from simplifying access to linked tax data across the different sources during an audit? And so to give you an idea of what we've already completed thanks to EDI and the pilot grant we received, we first surveyed all tax inspectors in Senegal, and we did find from their answer that private information and soft information plays a big role in their case selection. Okay? Secondly, we got confirmation that it's actually quite hard to link data across the different sources. For example, the customs with the corporate tax. Secondly, we did a big work of matching all the different data sets, using both the taxpayer IDs when we could, but also names, geography, location, and so on, to try to get at a big database which links the three types of tax return available to tax administration: corporate income tax, VAT, and payroll taxes, with data from outside the tax authority, from customs and procurement. We then, using this, we developed a risk score, which is trying to give a score to each firm for its risk of tax evasion, following what I would call international best practice. And I can come back to that, but it's based on 15 indicators. Some are directly inconsistencies across data sources, and other are what I would say irregularities. For example, you have repeatedly very low profit margin across firms. Right? And what's currently in the field, we've now done the selection based on the different method, and that's being tested this year. So there's three processes, I would say, for the way it works in Senegal. First, you have a case selection. At the beginning of the year, each tax inspector makes a list of firms they want to audit, and they send those. This gets approved. And then during the year, they perform those audits on a preset list. Okay? And then at the end of the audit, of course, you get the outcomes. So the first treatment is comparing the current discretionary selection, which is based on private information of auditors, some data they have access to, and potentially rent seeking, to a risk or selection that is fully data driven, to random selection. In the second stage, we cross-randomize each of the selection method with three possible treatments, or a control and two treatments. The current status quo, where inspectors do what they used to do. And then the first treatment, we reveal for each firm selected what are the risk flags that the risk score would have told about this firm. Okay, so for example, this firm, when we compare the customs data to the corporate income tax, seems to have a lot of experts, so it's declaring very low revenue. In the second treatment, we reveal the risk flag, but we also give to each inspector access to a simple expert spreadsheet that has all the merged data from all the different sources, accessible in a very simple format. So in a way, we're simplifying the data access to perform the audits. And then for outcomes, what we want to look is, in terms of tax administration, what's the assessment, what's the evasion rate, what's the recovery, because sometimes you assess an amount but the firm doesn't end up paying it, and what's the time spent per audit. And then we hope to supplement this with a taxpayer survey where we're going to try to get at what are the cost of audits for the firm and what are the experience with tax inspectors. So data collection measurement, the primary data is administrative data on the amount assessed, the amount recovered, the evasion rate. And then on the firm survey, and that's something I hope to get some feedback tomorrow on, what's the best way to ask potentially more sensitive questions, for example, do list experiments for bribes or for corruption, and more generally get a taxpayer satisfaction. Now, what we hope to do is to link this survey response with at least the treatment status, potentially with all the tax data. And I'll also be interested to get some feedback at, what are the potential risks of doing that and how we should approach maybe the IRB in doing this. This study, and you'll see the other study come back, it's quite close to two of the other studies. These other studies in this session, and we've been discussing a lot, and so thanks a lot for EDI for putting us in contact with both the India study and the other Senegal study. And I want to give you some quick early results. So the selection was completed in April, and audits are being conducted for the fiscal year of 2017. There's 52 inspectors, and that's something to keep in mind. We don't have a lot of inspectors, so it's hard to do inspector-level treatment. That's why we've been doing case-level treatments across the 7 main tax centers, which are really, you should think of them as divided by firm size, right? So there's the largest firms and so on. And so to give you an idea, for example, for the desk audit selection, what you can see is the risk score based on the method of selection, right? And the average risk score for the firms that are randomly selected is 25. You can see that the ones selected by the IRS are slightly more risky, so it's significant, but really not that much, right? And the ones selected by the algorithm obviously are the most risky and are much riskier than the ones selected by the IRS. In terms of differences across selection, what we notice is that the IRS tend to select firms that are quite a bit more profitable. Okay, thank you. Quite a bit more profitable, and that could be something we want to investigate too, which is often we hear from tax inspectors that they want to go after profitable firms because even if they assess a lot of evasions, sometimes firms don't pay afterwards the fine that they do. So that's for the desk audit, and you can see the result for the full audits. Know that we didn't do random audits for the full audits because of mainly of sample sizes and of the risk actually for total tax revenue of audits that might underperform. So what are some of the challenges, and I'm very happy to be at this conference for this. First, this is a collaboration that we hope to continue. We're going to continue next year and maybe even in the years after. And so there's further experimental designs we could do, for example, for 2019, and I would be really happy to get some feedback. 2 additional designs that we're considering. One is there's this big literature now on how human and machines interact in a lot of fields. We're looking at it in the case of tax audits, but it's also the case for credit scores, for example. And what's the best way of combining maybe the human private information and the advantage that humans might have with the machines? So something we could do, for example, is compare the current methods with one where there might be a set that is decided by the machine and the inspector selects from this set. So that's one way of thinking of combining the two. But there's other alternatives, and I would really like to talk about that tomorrow. The second one, which maybe is really interesting to think of counterfactual, which is there a way to really disentangle the value of that private information that inspectors might have from the other motives, like rent-seeking or bias, right? So one way would be to try to close the rent-seeking channel, for example, by announcing in advance a re-audit of specific sorts. So you could think of a second wave of audits, but have to think that those would then uncover perfectly evasion in the second round. And you could compare how the selection differ if you know that you're going to be re-audited. So those are 2 of the potential designs. They each have the difficulty in implementation, but that's some of the things we're thinking about. The second one is the taxpayer survey, and I'm going to show you a few of the goals. One is to get some general information on the firms that we might not have in the tax data, age, some more detailed information on activity, and maybe financial information, for example, credit constraints. The second one is to get a sense of what's the perception from these firms on the tax system, both fairness, what they perceive as the audit probability, the frequency, and so on. And third, and probably the more sensitive, is to get at their experience with dealing with the tax administration, both in the cost of audit, because full audits, for example, can have substantial costs because you really spend a lot of time. You have to make your accountant available to the tax administration and so on. But also what's the perceived corruption, bribes, and so on. Together with this, what we're thinking is maybe there's a second paper, which is maybe more of a methodological contribution, which is to look at systematic differences between administrative data, self-reported, and potentially an alternative measure that could be kind of a benchmark. And so there, for example, there's a Demel, McKinsey, and Woodruff paper that tries to say, how should we be asking information about firms to get at the revenue and the profitability? And so what they don't have is kind of the more admin data part, and we're wondering if that's something people would think is interesting to look further at. And then, if that is interesting, what is the best benchmark? And is there one that seems to be more agreed in the literature? They suggest, for example, that getting at the inputs of the firm would allow for a good measure of profit margin. Is that, is that something other people have replicated, or that seems to be agreed upon? I'm not sure yet. And thank you very much.
2 minutes for questions.
I went too fast.
So in terms of the risk score, what were the attributes that it was loading up on? Because why did it differ so much from the IRS?
So based on each of the individual, you're right. So we have a table on that. I'm not going to be able to tell you now because we have many. What's going to be interesting, I know tomorrow there's a session about machine learning and why we didn't go maybe that way. And I'll have more details there. But one of the impressions with the data we had in the past was very selective. So we really didn't have a good test sample to start going and doing something more.
And were you using all the tax data, all the linked data for the risk score?
Yes, that's right. Which the inspectors didn't necessarily have access to, or only at the cost of kind of high effort. Right? Okay. Yeah, Andrew.
Do you think the inspectors think about firms that are good to make examples of, apart from just the outcomes for that particular firm, so prominent firms or firms that are likely to get noticed? Is there any sense in which they might have objective functions that are legitimate but differ from what you
No, that's a great, and I think all this literature suffers from a bit of a multitasking problem, right? So that's why we did the survey, to try to get, at least to say that's what the inspectors reveal are their objectives. So we have some measures we could put on them. And again, I probably have to tell you more on some of these other measures. And that's possible, yeah.
So I was going to ask how much you've tried to reverse engineer what the inspectors are trying to maximize.
So in the survey, a lot, and we realize it's very hard, right?
And then, but by using the data, in the sense that they might have an objective that's recoverable somehow. For example, they are targeting firms that are more profitable. Maybe they predict already that other firms are very hard to cash in on, and they want to maximize revenue, for example, which is a totally benevolent objective.
Yeah.
But they're adjusting to the fact that they know that very risky firms that won't pay are not worth going after. So maybe we should talk.
Great. I'll tell you a quick answer. We wanted to go quite parametric at the end and say, could we recover the full kind of way they're doing this? And so in a way, the survey, we have what we need to do that because we have very detailed questions about each type of data source. For example, do you use it or not? Why don't you use it? What are all the objectives? We haven't, maybe we should go back and try to explore that a lot more, and we'll do it at some point. We encounter a few roadblocks, and I'd be happy to tell you, why we think that is. Or